Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Well, money makes the world go round, so why not get in the driver's seat and enjoy the ride? If you don't know how, then don't worry. Help is on the way. Welcome to the Mutual Fund Day Family Financial Plan series here on CNBC TV 18, a show that helps you chart the best route for reaching financial security. Each episode offers insights gleaned from case studies based across India. Our latest investor is from the city of New Delhi. His name is Amit Gupta. Let's start things off with a quick look at the rearview mirror of him and his family's financial planning journey.
On this episode of Mutual Fund Day Family Financial Plan series, we bring you the financial case study of Mr. Amit Gupta, a businessman from New Delhi. He lives with his spouse Babita Gupta, who is a housemaker, and his daughters Ishani and Charu Gupta.
I'm into an online business. I used to work for corporates earlier, but now I'm on my own with my own business right now. I have my wife and two daughters in the family. My elder daughter is pursuing a sales and marketing job in Bangalore, and my younger daughter has recently passed out of 12th, and she's now going in for undergraduate competitions. Well, I started doing investment in the year 2006, and the first investment I did was with the mutual funds. And I was fortunate enough to have a good financial advisor who introduced me to the mutual funds for the first time. And slowly we started building up this portfolio of ours. I started with a small investment, but then gradually over a period of 10 years now. And what I think is that, the journey has been quite interesting and good, because it has not only shown me my money growing, but it is also giving me a sense of security and a good future that I can see along with these investments. And meeting my short-term goals was never an issue, because whenever I wanted money, this portfolio or this investment could always give me whatever I wanted. So I could withdraw also, and it was a regular dividend income that was coming to me. I did not face any challenges in achieving any of my short-term goals that way. As far as any investment not going in my favor, it doesn't actually matter, because the portfolio has been quite diversified, and some of the funds might have not done so well at any point of time, but then overall the portfolio was doing very well. So I did not face any challenges as such or investments going wrong. But then, and whenever I wanted any money for any other purpose other than investment, I could always withdraw, because the portfolio was quite diversified and it had liquid funds in it, which could give me the desired money at any point of time.
Mr. Gupta started investing in 2006. His investments include mutual fund investments, 59.2% of which is debt, 39% are equity investments, and 1.8% gold investments. He started investing for his daughters from the year 2010. Today, both the daughters have separate financial portfolios.
My short-term goal is just to be steady on the finances right now, because I've come into entrepreneurship right now after leaving my job, and my short-term goal is just to sustain the current entrepreneurship that I'm doing right now, and my long-term goals could be a stability in the family and the income, so that there is a regular flow of income along with the business income. There is a sense of security through my investments, which I'm actually pursuing in mutual funds. I think I got slightly late in getting into the investment part, but then I started doing it in 2006. And since 2006, it has been a regular journey wherein I am investing almost every month regularly through SIPs and through other mutual fund investments. And it has been a steady business and income all throughout for the last 10-11 odd years. So.
With a structured fiscal planning, Mr. and Mrs. Gupta look at mutual funds as an instrument to achieve their long-term and short-term goals and to grow their wealth.
See, the investments in mutual funds is, as I said, is not only giving me a financial support, but it is also securing my future. I have certain commitments towards the family My daughters have to get settled first in their career, then in their life. So I think this investment of mine will come very handy whenever I need it, and it will make me much more comfortable throughout the life.
Well, now that we have a broad understanding of our featured investors' financial planning, let's take a short break. Coming up is a detailed analysis of the Gupta family's balance sheet. Our guide for this episode will be Ashish Chadda, an independent financial planner. Keep watching CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to the Mutual Fund Day Family Financial Plan series. Now, the previous segment highlighted our featured investor Amit Gupta's approach to financial security. Amit, thank you so much for joining us. Give us a specific outline of your asset allocation for the benefit of our viewers.
If you look at the financial asset that I own, it's almost 60% into property and 40% into the financial asset, which is a mutual fund that I own. And out of that 40%, almost about 50% of that is into short-term debts and balances into the long-term debts. And the portfolio has been actually divided into a lot of segments wherein, we cover almost a decent amount of foreign funds to hedge, something on gold and something on short-term debts for the liquidity, and for long-term debts for future, investments and future growth.
All right, so that's the blueprint of your investments. Ashish, let me come to you for an analysis, a diagnosis of his portfolio. I noticed there's significant preference for debt funds, especially the long-term variety, versus equity. What's your take on this? Why the preference?
Yes, Mr. Gupta was a very senior corporate executive who chose to migrate and turn entrepreneur. Plus, his family profile is such that, two daughters at that point in time were going to college. One of them is now working, and the other one is now going to go into college. So there was a need to, because he was turning entrepreneur, that regular income stream would be curtailed. Plus, in case the business needs money, as also the fact that, children are going to college. So there was a need to take a lesser risk and have more liquid cash in case he needed.
Okay. And considering that long-term debt is more vulnerable to interest rate moves, do you see more enhancement of his short-term debt portfolio?
We have actually medium-term funds.
Okay.
What is being categorized as long-term debt is actually medium-term funds. So they are not going to be vulnerable to interest rate movements beyond, and they've also been held now for 4 years. So we've also at this point in time captured a lot of the interest rate cut that was factored in. And it's also balanced at a portfolio level with the equity holdings. The equity portfolio is done extremely well. We're sitting on very large, fortunately, very good long-term tax-free returns. So when I break it down, individually it may reflect something on the line that you're saying, but at a portfolio level it doesn't matter, because the equity side is done extremely well. And even of late, when interest rates have moved up on the GSEC market, the liquid and the short-term debt rates have also got repriced. So it works out quite well.
All right. And should debt funds be seen as a capital preservation measure rather than just a wealth maximizing measure? What's your view on this?
Yes. So I think to answer your question, what is the rule? No bank FD is guaranteed beyond a lakh of rupees. So I think that is the context in which you come up to debt funds. Debt funds hope to keep your principal safe. And by and large, over the last, I've now been in business for almost 25 years. By and large, they have delivered, but companies do go bankrupt. Companies do get into payment problems. So every once in a while, every debt fund scheme of every AMC is vulnerable. So investors should never forget the only thing which is safe is a treasury bill or a GSEC, but there also you carry a price risk. The principal is only safe on these two products. Okay.
And in terms of a realistic expectation, Ashish, from say a debt fund or an equity fund, what would you say is a realistic expectation for people who are watching this show right now? What would you say to them?
Yes. So one is at a very basic level, whatever is the 10-year bond rate. Now, So currently the rate is 6.94%. Knock off 30% on taxes. So you are down to about 5%. So as long as you do about 200 to 300 basis point higher, so if you can do about 6.5%, 7%, I think you should be satisfied. That's one part of the answer. The other part of the answer is over a longer period of time when you migrate towards equity, typically it will be a mix of GDP growth rates, inflation, and corporates generally tend to do 2 to 3% higher. So that is the range in which equity will move. Historically, we have done about a 15% plus tax-free return on Indian equities over the last 15 to 20 years. Going forward, I think that will also get tempered because now our inflation rates are down to 4 and 5%. Our GDP growth rates, even if they're at 6-7%, and add 1 or 2% for corporates doing better. So I think the returns may probably come down.
You have some direct exposure in stocks as well, right?
Yeah.
Okay, so is that going to be at the same level? I believe it's 3% of your net worth. So is that what was the reasoning behind that? Why a direct investment into these stocks?
Actually, in fact, before I started investing into mutual funds, I invested into a few blue chip companies, and that were a smaller proportion. But then I've held it for a long time now. So the returns are pretty good because it's a very, very old. I'm not doing direct stocks right now, but because most of my investments go into the mutual funds now. But then those blue chip stocks which I've already purchased some 10 years back, I still hold them.
All right. Ashish, how would you assess Mr. Gupta's portfolio in terms of tax planning? Any tweaks that you would suggest? Because that's a question which a lot of people also have, that when they create that investment portfolio, there needs to be tax planning integrated into it as well. So what's your assessment of Mr. Gupta's portfolio in terms of tax planning, and what tweaks would you suggest to viewers?
Yeah, so in Mr. Gupta's case, our portfolios are extremely tax efficient.
Okay.
On his portfolio, we pay hardly any income tax, taking advantage of the rules which are present on his return, because long-term equity is tax-free. If you hold fixed income beyond 3 years, it tends to get tax efficient. As also that arbitrage funds also have a tax-free component. So as of now, it's a good place. I think here the bigger thing is I hope rules don't change going forward. So if these rules stay just the way they are, then I think we're doing just fine.
All right. And any pro tips for our viewers when they approach their financial planners and they want tax planning as a key component of their investments? What would you suggest to them, the questions that they ask their financial planners?
Yes. So one should never confuse tax planning for that 80C benefits with a long-term portfolio construct. The tail cannot wag the dog. You have to first get your long-term goals. So have a conversation with your financial advisor. There are lots of very good people in the market who've been in business for many, many years. Strike up an equation, because please remember that it is not a one-off online purchase or sale of a stock or a fund. You are building relationships over 10, 15, 20, 30 years, maybe longer. Now we are working with almost the 4th generation. So try and get a good sync with the financial advisor. If you do that, everything else will follow.
All right. On that note, let's take a quick break. Stay tuned for the Mutual Fund Day Family Financial Plan series as we reveal more insights into money management just for you. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
We're on the last leg of this episode of the Mutual Fund Day Family Financial Plan series. Let's pick up where we left off with our guests. Now, Amit, you have 2 daughters who have their separate investment portfolios, and one of your daughters is managing her investment portfolio independently. You have a significant investment in property. How does this all tie in with your retirement planning portfolio?
Most of it was done with a view that the money should not be idle. It should be put to a good use. And, obviously not as a retirement plan, but then, what you understand is that you need to take a break someday. And when that day comes, when you need to take a break or need to be comfortable in life further without exerting too much on work, these are the things which comes very handy to you. I mean, especially, when your daughters are growing, your children are growing, and, when they need a higher education or they get an opportunity to go for higher education, to build their careers, this money comes very handy. So the portfolio was built and this investment started only with the view that, when you get on to less productive years of your life, you still maintain the similar kind of lifestyle and you don't go down. And obviously the inflation you have to beat at any point of time. So this was basically done to that. And to come on to that my daughters are doing it independently now, this I realized, that I started doing investment slightly later in life, whereas I should have started doing this maybe 8 to 10 years earlier.
Now, Ashish, Amit mentioned that he started a bit late when it comes to financial planning. What do you think is the ideal time to start retirement planning for the benefit of our viewers who are wondering, when do they start on the retirement planning mode of their finances? What would your advice be to them?
Money can't buy you happiness, but it can pretty much do everything else. So there is a need to do it. The important thing about retirement planning is that when you are young, when you are like 21 years old, just starting a career, retirement is very far away. But I think folks like us, asset management companies, insurance companies, need to create that awareness that you would want to stick away 3 to 4% of your savings into extremely long-term assets. As people grow older, they come into 30s and 35s, especially men, they will not get into retirement planning mode. It's only when they have a baby and when the wife, starts talking about it, is when men tend to be more conscientious. And what my experience is that after at the age of about 40 is when retirement planning starts to show up on horizon. But in the case of women, they're far more pragmatic. And my experience is that they will squirrel away a little sum of money even when they just start working towards retirement.
All right. Now, you've shifted from the salaried world to running your own business, which again brings with it volatility. Any provisioning for emergency funds that you've made, Amit?
Well, I do have some short-term liquid funds in my portfolio, and as you said, as we have discussed earlier, I have some, allocation into the property also. So that takes care of my, immediate needs, if at all I need to. And I do understand, that I don't get a salary every month, but then my valuation for my company is building up, and I know that it will start paying me whenever I need it. So as far as provisioning is concerned, I think liquid funds are good enough for me, which are sizable in my portfolio as of now. And but fortunately, I have not had a requirement for that too much. But then whenever I needed, twice or thrice I had a requirement, and I got it very instantly. So it is helping me. So
all right.
It doesn't matter to me that regular salary is there or not, but then
You've created your alternate income source from your investments as well. In terms of creating an emergency fund, Ashish, what do you think are the key elements which our viewers should take into consideration when they're provisioning for an emergency fund?
Yeah, so, each person will have their own circumstances, but let me, drill it down. So there'll be a whole lot of viewers who work with the government. There will be a whole bunch of viewers who are entrepreneurs, and there'll be a whole bunch of people who work in the private sector. The only guys who are safe are the government guys. So they probably are okay if they have about 3 months of expenditure in the bank. Business people, because they run a high, their return on investment is higher, our suggestion to them is try and keep a year's expenditure in a liquid fund, and a bank FD. That is sensible. In the case of the private sector, you see job retrenchments happen all the time. And they tend to have more money, so they also tend to fly off the handle, especially when they're younger. My suggestion for them is they must always have 3 months of expenditure, and a year's EMI must be tucked away into a combination of bank FDs and liquid funds. That is the kind of liquidity you need to create before you start going into longer term assets.
All right. Now, before we wrap up this discussion, let's get a summary statement from both of you. Now, I'm just going to ask you about the key lessons that you have learned in your financial planning journey. What would those be, Amit?
I think the most important point when you consider investment, you start investing, is that you have to understand that investment is not overnight, or it is not a return which you can get overnight. You have to wait. You have to plan it. Maybe you do it with your extra income, which is not required immediately, but then investment will pay you over a longer period of time, say about 10 to 15 years. you must be ready for that. Then only you start getting a sizable return on that. And on the second part, if I tell you that when you ask me that being from salaried to doing our own business, I think the first thing that I did after leaving my job was that I became debt free. So whatever money I could have, with that I finished off all my debts, so that even in a bad time, I'm not hit with the EMI pressure on my head. So that has actually helped me a lot. So my suggestion is that if you are going on to a different journey from trying to get into entrepreneurship from a salaried, try to be as free as possible from the debts or the EMI pressure, and take investment on a long-term note. Maybe you have a different portfolio, that you have short-term liquid funds, everything, it has to be diversified. But then investment has to be looked purely as an investment, not as a money spinner overnight.
All right. And Ashish, your word of advice to viewers who might be starting their investment planning journey soon enough, what's the key pitfalls to avoid in your opinion?
So some viewers may want to do it direct, and some viewers may want to find someone like me to help them in their journey. So I have suggestions for both. If you want to go direct, please spend at least 3 hours a day on reading. What is common to both is asset allocation and patience. Because you will only make money if your asset allocation is sensible and you're not chasing the highest return asset class at this point in time, and you have enough liquidity that in case there is a mishap or you get fired at work, that you have enough cash which will take care of your current expenditure. For people who would want to find someone like me to help them walk their journey, my suggestion would be, first see, does this person speak sensibly? Sensibly does not mean agreeing with you. Is this person willing to give you an opinion which you may completely disagree with? And have a conversation. These are journeys that for us, they have now lasted almost 20-25 years. And if I go back in time to my father's business, some of the relations are almost 35 years old, and we still continue to serve them. So the sense is, you have to find someone whom you can trust. And once you have that, please, you also must read aggressively, share your views, have a good, honest conversation, and be aggressive in your conversation, because in the end, it is good for you as well as your financial advisor, because that will help optimize your portfolio.
All right. So trust, transparency, and knowledge, those are the key elements to go in that. Gentlemen, thank you so much for joining us. This has been a great speaking with you and, of course, discovering your story of financial planning, Amit. On that note, let's conclude this episode of the Mutual Fund Day Family Financial Planning Series. Thank you to our guests for sharing their lessons and insights. And, of course, thanks to our viewers for tuning in. We'll be back with a brand new journey of financial planning for the next show. Keep watching CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.